Have you ever paused to consider why some individuals seem to navigate the world of finance with such apparent ease, building wealth and security, while others find themselves constantly struggling to make ends meet? The answer, more often than not, lies in a fundamental understanding of two core concepts: assets and liabilities. Welcome to Money Deconstructed, the channel dedicated to breaking down the complexities of finance into clear, digestible insights that empower you to take control of your financial future. Today, we embark on a journey to fully understand the building blocks of financial health, assets and liabilities. This isn't just about knowing the definitions, it's about grasping their profound implications for your financial well-being and how mastering these concepts can truly transform your financial life. To truly appreciate the significance of assets and liabilities, let's consider a simple analogy. Imagine you're building a house. In this scenario, your assets are like the bricks, the wood, the roof, all the elements that contribute to the value and stability of your home. Your liabilities, on the other hand, are like the loans you might have taken out to purchase those materials or hire the construction crew. The difference between what your house is worth, your assets, and what you still owe on it, your liabilities, represents your equity, or in financial terms, your net worth. This brings us to a crucial equation in the world of finance. Assets minus liabilities equals net worth. Your net worth acts as a snapshot, a current measure of your financial health. The ultimate goal for most of us is to see that net worth grows steadily over time. Understanding assets and liabilities is not just an academic exercise. It is the very foundation upon which financial literacy and wealth building are constructed. It equips you with the knowledge necessary to make informed decisions about your money, paving the way for a more secure and prosperous future. Let's begin by dissecting the concept of assets. In its simplest form, an asset is anything you own that holds economic value and has the potential to put money back into your pocket. That last part is key: puts money in your pocket. Think of it as something that works for you, either by generating income or by increasing in value over time. There are various categories of assets, each with its own characteristics. One common type is liquid assets. These are assets that can be easily and quickly converted into cash without losing significant value. Examples include the cash you have on hand, the money sitting in your checking account, and the funds held in your savings account. These are your readily available resources. Then we have investments, which are assets purchased with the expectation that they will generate income or increase in value over time. This category encompasses a wide range of options, such as stocks, where you own a small piece of a company, bonds, which represent a loan you've made to a government or corporation, mutual funds and ETFs, which are baskets of various investments, and even real estate, specifically rental properties that generate income through rent. Another significant asset for many is their primary residence, the home they live in. While it provides shelter and personal value, from a purely financial perspective, it can also be considered an asset as it has the potential to appreciate in value over time and contributes to your overall equity as you pay down your mortgage. However, it's important to note a distinction here. While your home is an asset, the mortgage you have on it is a liability, which we'll discuss later. Finally, we have personal property, which includes your tangible possessions like vehicles, furniture, and jewelry. While these items have value, it's crucial to understand that many of them, particularly vehicles and everyday household items, tend to depreciate in value over time. This means they typically lose value rather than gain it, so while they are things you own, they might not always be considered strong income-generating assets in the traditional sense. Depending on the broader focus of our channel, we might also touch upon business assets, such as equipment, inventory, and intellectual property, which are crucial for businesses to generate revenue. Now, let's turn our attention to the other side of the financial coin: liabilities. A liability is essentially something you owe to someone else. It represents a financial obligation that will take money out of your pocket in the future. The key phrase here is, takes money out of your pocket. These are your debts and financial responsibilities. Just like assets, liabilities can be categorized in different ways. One common distinction is between short-term and long-term liabilities. Short-term liabilities are debts that are typically due within a year. Examples include credit card debt, which can accrue significant interest if not paid off promptly, short-term loans, which might be used for immediate needs, and even outstanding medical bills. These are obligations that generally require quick attention. On the other hand, long-term liabilities are debts that are paid off over a period longer than a year. The most common examples include a mortgage, which is a loan used to purchase a home, student loans, which help finance education, car loans, used to purchase vehicles, and personal loans taken out for various purposes. These represent significant financial commitments that extend over many years. Beyond these categories, there can also be other types of liabilities, such as taxes owed to the government, which require future payment. Understanding the fundamental difference between assets and liabilities is absolutely crucial for building a strong financial foundation. Remember, assets are designed to put money into your pocket, either through income generation or appreciation in value. Think of a rental property bringing in monthly rent or a stock investment that pays dividends or increases in price. Liabilities, conversely, take money out of your pocket through payments, interest, and fees. Consider your monthly mortgage payment, your credit card bill, or the interest you pay on a loan. The core goal in managing your personal finances effectively is to accumulate more income-generating assets while diligently managing and minimizing your liabilities. This positive difference is what ultimately leads to increased net worth and financial security. To gain a clearer picture of your overall financial health at any given time, it's incredibly helpful to understand the concept of a personal balance sheet. A balance sheet is essentially a financial statement that provides a snapshot of your assets, your liabilities, and consequently, your net worth at a specific point in time. Think of it as a financial report card for yourself. Creating your own personal balance sheet is a powerful exercise. To do this, you would first list all of your assets, estimating their current market value. Be as accurate as possible. This would include your cash, bank account balances, investment values, the estimated value of your home, and any other assets you own. Next, you would list all of your liabilities, noting the outstanding balance for each debt. This would include your mortgage balance, student loan balance, car loan balance, credit card balances, and any other outstanding loans. Once you have a comprehensive list of both your assets and your liabilities, you can calculate your net worth by simply subtracting your total liabilities from your total assets. The resulting number provides a clear indication of your current financial standing. A positive net worth means that the value of your assets exceeds your liabilities, which is generally a healthy financial position. Conversely, a negative net worth indicates that you owe more than you own. It's important to remember that your balance sheet is not a static document. It's a dynamic tool that should be reviewed and updated periodically, perhaps annually or even more frequently, to track your progress and identify areas for improvement. Why does all of this matter in the grand scheme of things? Understanding assets and liabilities is not just about numbers on a page. It's directly linked to your ability to achieve your long-term financial goals and ultimately attain financial freedom. Whether your aspirations include a comfortable retirement, purchasing a dream home, funding your children's education, or simply having the peace of mind that comes with financial security, a solid grasp of assets and liabilities is absolutely essential. Building wealth is often a direct result of strategically acquiring assets that either appreciate in value over time, like certain investments or real estate, or generate a consistent stream of income, such as dividend-paying stocks or rental properties. Simultaneously, effectively managing and reducing liabilities, particularly high-interest debt, frees up more of your income to be directed towards building those assets. The ultimate aim for many is to reach a point where their income-generating assets produce enough passive income to cover their living expenses, leading to true financial freedom and the ability to make choices based on their passions rather than solely on financial necessity. So, what practical steps can you take to start taking control of your finances by focusing on assets and liabilities? The very first step is to get a clear picture of your current situation. Take some time to list out all of your assets and their estimated current value, as well as all of your liabilities and the outstanding amounts you owe. This will give you a baseline understanding of your net worth. Once you have this information, you can start developing strategies to increase your assets. This often involves prioritizing saving a portion of your income regularly and then strategically investing those savings in assets that align with your risk tolerance and financial goals. Explore different investment options, learn about their potential returns and associated risks, and consider seeking professional advice if needed. Beyond traditional investments, think about opportunities to acquire other types of income-generating assets. Simultaneously, it's crucial to develop a plan to manage and reduce your liabilities. Focus on paying down high-interest debt first, as this can significantly impact your cash flow. Avoid taking on unnecessary new debt, and when you do need to borrow, make informed decisions about the terms and interest rates. It's also important to address some common misconceptions surrounding assets and liabilities. For instance, many people believe that their car is always a strong asset. While it certainly has value and provides transportation, the reality is that most vehicles depreciate significantly over time, meaning they lose value rather than gain it. The loan you took out to purchase it is definitely a liability. It's crucial to differentiate between assets that truly have the potential to grow your wealth and possessions that primarily serve a personal need and may decrease in value. Another common misconception is not recognizing the difference between what's often referred to as good debt and bad debt. Good debt might be considered borrowing that allows you to acquire an asset that has the potential to appreciate or generate income, such as a mortgage on a rental property or a loan to start a profitable business. Bad debt, on the other hand, is often high-interest consumer debt used to purchase non-essential items that don't generate future income or appreciate in value. Finally, it's easy to overvalue personal possessions when calculating your net worth. While your furniture and electronics have some value, their resale value is often much lower than their purchase price, and they typically don't contribute to increasing your wealth. In conclusion, understanding the fundamental concepts of assets and liabilities is not just for financial professionals. It's a crucial life skill that empowers you to take control of your financial destiny. Remember that assets are what you own that can put money in your pocket, while liabilities are what you owe that take money out. The difference between the two determines your net worth, which serves as a vital indicator of your financial health. By focusing on strategically building income-generating assets and diligently managing and reducing your liabilities, you can pave the way for a more secure and prosperous financial future. We encourage you to reflect on your own financial situation and start taking steps today to better understand and manage your assets and liabilities. Now, we'd love to hear from you. What are some of the biggest assets and liabilities you currently have? Share your thoughts in the comments section below. What questions do you still have about assets and liabilities? Let us know, and we might address them in a future video. If you found this audiobook helpful and informative, please give it a thumbs up. And if you're new to Money Deconstructed or haven't already, be sure to subscribe to our channel for more insightful content on personal finance. Don't forget to hit the notification bell so you don't miss out on our next video, where we might be discussing different types of investments or strategies for managing debt. Thank you for listening to Money Deconstructed. We truly hope this audiobook has provided you with a clearer understanding of assets and liabilities. Remember, taking control of your financial journey starts with knowledge, and we're here to guide you every step of the way. Until next time, take care and keep building your financial understanding.